All right, folks, welcome to Investing for Beginners podcast. Today, we're going to do part 2 of stocks behind everyday life. Last session, part 1, we talked about different places you could look for stock ideas in your everyday life. So instead of just returning to screeners, you could actually pay attention to the things you interact with and use on a daily basis, and those could be a good to find investment ideas. So the last session, we discussed, for example, your morning routine, maybe places you go, how you got to work every day, and companies kind of associated with that. And today we thought we would take a look at companies you could find at work and places associated with your workday life. So let's start with, I guess, at work. What are some companies that you think would be a good choice to think about looking at?
Man, there's so many. Shout out to the people who commented, though. Thank you, Daniel, Grant, Kyle, and nice comments about Adobe too, Kyle. I think that was really insightful. So appreciate you guys commenting and happy to be here for part 2. I don't really have like a super favorite. I know you got like a list, right? But which one would you want to start on first?
Let's start with the overlord. Let's start with Google.
Ooh, okay. First thing on my homepage, right? New tab.
Yep.
Blank slate. Going to be a good Monday, right?
Yes.
Well, Google over the last 5 years in the stock market has returned 27% a year. So that would be a pretty nice return if you bought it during the depths of the pandemic. By the way, I just want to say this. 27% a year, you're like, okay, that sounds good, right? But over a 5-year period, that's 236%. So the stock more than tripled, by the way. Just want to throw that out there. So 27% a year is a nice thing and will make you lots and lots of money. We're talking about a company with $370 billion in revenue and continuing to grow revenue. Last 3 years, 10% a year. Its average over the last 10 years, 18%. Obviously, that's slowed down, but still, you grow 3 years in a row at around 10% a year. It's no surprise, maybe, that the stock has done so well. When you think of Google, like, what do you think of as far as maybe things about the stock that people don't necessarily understand?
I think everybody's heard of YouTube at this point.
Yeah.
But what I don't think people realize is it's the number 2 search platform in the world. So they have Google Search, which is, a verb.
Yeah.
And now you have YouTube, and they're the second largest. And I don't think people realize how strong of a position that puts the company in. So that to me is huge. I think the other thing that probably gets overshadowed is how well Google Cloud has done coming from behind, really being the very, very distant third player among the big hyperscalers, i.e. Amazon, AWS, and Microsoft Azure. They have kicked some serious booty, and they've done really, really, really well over the last 3 or 4 years. And it's turned from a negative profit business to a profitable business for the business unit itself, which is impressive. And so I think that really flies under the radar when you compare it to search and YouTube. And I also think that the AI part of it is now maybe starting to get some love, whereas before it was kind of mocked and ridiculed, rightly so, because they really were fumbling out of the gate the whole competition with ChatGPT and everything that was going on with OpenAI. So to me, those are the things that really kind of fly under the radar about Google. What about you?
Just because you mentioned it with the whole Google Cloud thing, which is mind-boggling, it actually makes more revenue now than YouTube ads. That's massive.
It's nuts,
crazy.
Yeah.
And they've grown that very fast since 2017. They've more than 10x revenue for Google Cloud. Last thing that stands out to me, just because I'm a boring balance sheet guy, is they are net debt free, so they have more cash than debt, and they have $95 billion in cash, which is a lot of money.
It would be nice to see that in the checking account, would it not?
It wouldn't be a bad day. All right. We're in Google. What are we typing into Google? Where's your first place you go? You got to check something, right? Are you checking your Twitter? You
Yeah.
check. What are you on email? What are you doing?
I'm gonna actually go to my CRM.
Okay.
So I'm
Wow.
gonna look.
Busy bee.
Yeah, yeah, I know. I'm gonna look up at Salesforce.
Let's look at Salesforce. The ticker is CRM. Over the last 5 years, the stock has actually declined. It's down 0.7% annually. But the company itself has grown a lot. Similar to Google, it's slowed down the last 3 years, but still an average of 10% a year. Over the last 10 years, it's 20% a year if you look at that average. So has historically grown really fast, still growing at a good clip, and revenue of about 40 billion. So that's maybe bigger than I would have thought. That's a lot of revenue for a software company. I don't think we
Yeah.
think of software companies as big revenue. We were looking at what was it, Keurig and some of the other big consumer facing names. I don't remember how many of them had 40 billion in revenue, but I don't think it was many of them.
No, no, I don't think so either. The thing I think about when I think about Salesforce is I always associate them with Slack because that's what I have used from their business. But I know that they have a lot of Office uses to make what people do inter office more seamless and more efficient and more effective. And I think that's really why they've been able to stay. It's not young. It's been around for a while now. And Mark Benioff, who's the founder and CEO, he's been around forever. So they're more of the dinosaur in the race, but they still got some legitimacy to them for sure.
Gross margins almost 78%. Operating margins still down to 22% or 21%, excuse me. So I'm no expert, but software company at 21% operating margin can probably get those numbers higher. And so you would think that that would lead to more EPS growth. EPS growth has been nice for the company. You take last 5 years and growing over 20% a year in earnings per share. So that's a nice growth rate. And I think when I always thought of Salesforce, because we've been doing this a while, I never would have thought of them as a dividend paying company. They now officially pay a dividend, which is something you would want to see for a value guy like me. So that's very interesting. The PE is actually down to 19. Oh, I'm sorry. Next 12 months, PE of almost 20. Forward PE, backwards PE 34. But there's a lot of stock based compensation too, so we can't.
Yeah.
If you're going to invest in this company, go research stock based compensation.
Yes. Before you do, please,
Yeah.
by all means.
PE does not help you with stock based compensation.
Does not.
All right. Maybe we're a salesperson. We had some rough sales calls. If it was me, I'd probably need like a caffeine jolt or something to kind of pick me up. Where do you want to go to get some caffeine?
Well, Starbucks, duh.
Starbucks. I'm shocked that we didn't mention
They got one
them.
down in the lobby, right?
Right? Yeah, they should. Or otherwise, go change your company. Right? No, just kidding.
Right.
Starbucks. I'm surprised we didn't talk about them in part one. But last 5 years, the stock's actually flat, almost perfectly flat. Obviously, you get a little roller coaster, up, down, up, down. But yeah, if you would have bought 5 years ago to today, you would not have seen any share appreciation from that. Growth is slowing there, almost 5% annually over the last 3 years, 7% over the last 10 years. Sales of 37 billion. So with just the fact that Starbucks is everywhere, I don't know. I guess I would have thought it would have been a higher number because we just set a number that's lower than Salesforce. So Starbucks is real. I can see it. Salesforce is a little thing on a website,
Right.
This does not compute, but here we are.
Well, I think that when I think about Starbucks, I also think about you getting a $6 coffee, me getting a $6 coffee, and if you take $6 coffee into 35 billion in revenue, that's a lot of coffee.
That's true. Good point. Yeah.
So so there's a lot of even though it's a big company and it's everywhere, the per person average is much lower than fast food restaurants, for example. So even going to McDonald's, you're not going to get out of there without spending less than $10, $11.
I found it interesting that out of the almost 37 billion in revenue, 22 is beverage. The remaining others is food and other product type, which is like licensing. You know, you go get a K cup and it's a Starbucks brand. And then you also have international revenue plays a decent part of that, 7.6 billion out of 36, 37. That's an important thing for Starbucks too. It's a international business, not just US.
Right. I know China has been big on their growth plans for
Hmm.
sure.
Yes. Yep.
All right. So we get done with our coffee and we have to go back to work and we have to get on a call. I'm going to have to dial up Zoom
Okay. Yeah, let's do
to
it.
do the video call.
The pandemic darling.
Pandemic darling.
Yeah.
How have they done since?
Ticker ZM. You don't want to hear this.
Okay.
Nobody wants to hear this. This is a sad, sad story. Last 5 years, Zoom is down 83%. It went from over $500 a share to now $82 a share. So that's losing 30% a year. That's pretty bad. But revenue 4.75 billion. It's a pretty good size. I don't know why. I would have thought of
Yeah.
Zoom as like a couple billion or something, but they're driving a lot of revenue. I honestly can't really think how does this company make money because I've never really looked at them deeply. I couldn't even tell you
Yeah.
how they make money. Low PE though. PE 21, and over the last 3 years, growth has slowed quite a bit. I don't know if that's because of like tougher comps, the whole Wall Street saying. I guess if you look at past 5 years, revenue has grown 20, almost 29% annually per year. So it's like, wow, business has grown by a ton, revenue is up a ton, and the stock's down a bunch. What's the lesson there, if anything?
The lesson is that for me, you have to understand what the business does and you have to understand how it fits in the ecosystem and what is realistic for the company. If you talk about what happened during the pandemic, it's obvious that everything got pulled forward for the business and everybody thought that this was going to be the new dichotomy. This is how we were all going to do business. I think we all overestimated how much we really were going to do business that way and maybe how much human interaction still really matters. So I think without for me, if I looked at the business, how do they make money? They make money from this and this. Okay. Do I think that's going to continue? And how likely is that? Is this the new paradigm? Is this the new way we're going to do things? And I guess I probably would have been more skeptical about it. It's easy for me to say in hindsight, of course, but I think even at the time I was like, I don't see this being a thing beyond the pandemic because everybody complained about it. So
Yeah, for me, I'm the strict teacher from the 70s who's like wrapping your desk with a long yardstick. The PE was 800. It got down to like a 170. That's the price
oh
to earnings
boy.
ratio. And your price to sales in 2021 was 42. And in 2020, it was
Boy.
34. So price to sales, you generally don't want to see that much higher than 10. And it was, 40. I remember the days when a 10 price to sales used to be considered high. And now I'm saying
Right.
like, you don't want to, the 10 might be decent. But
Right.
yeah, just huge price to sales, huge price to earnings. This is what happens when you play silly games, you get silly outcomes.
Yes.
But to your point, like if it would have been a thing, if it would have been not pulled forward, if everybody would have been on Zoom and nothing else, then maybe this is a different story and maybe the stock would have been one of the great performers. That's the thing,
Yeah.
you just never know.
No, you do not. You do not. So let's say we work in marketing, we work in design. We need a computer. Contrary to what Steven says, we're going to buy a Dell.
Okay.
So look at Dell computers because I think they're solid computers and they could be a good investment. I don't know.
Over the last 5 years, the stock is up 17% a year, has done pretty nice. This interesting U shape where it came down quite a bit after 2021 and then rocketed up higher. And it's now at that nice gain level. We're talking about revenue of 100 billion. There's a lot of computers being sold and that's way more than what I would have thought.
Yeah, yeah, for sure. Way, way, way more.
Yeah.
I mean, to put that in perspective, the last show we were talking about Visa, and they are doing annually 30 billion in revenue a year.
Right.
And so this is it's over 3 times that.
Yeah.
So
not growing much over the last 3 years. Revenue's actually down. Over the last 10 years, revenue's up 6.5% annually. Not terrible from a 10-year perspective, but it looks like things could be slowing down now. It's a low margin business. If you know about kind of tech hardware or just some consumer products in general can be low margin. So if, revenue's at 100 billion, but gross margins a little over 20% and your operating margin is 7.3%. So you look at that 100 billion in sales, it's a big number. It sounds really impressive, but with a low margin business, not a lot of that's going to shareholders. So you really have to watch the margins closely, because when margins are so small, big swings will make huge impacts to their ending profits.
yeah, it's not just about the top line number, it's also about the bottom line number and what happens in between all those things.
Yeah. Yeah, totally. All this work talk's making me hungry. So can we order something? What do we got
Yes.
options wise?
We got choices here. So we could do something like a cool thing to do would be to get some Wendy's from DoorDash.
Oh, okay.
So we could do a two for one.
Are you getting? You're just saying Wendy's because you like the Dave's. What do they call those sandwiches?
Hot chickens or whatever.
No.
No.
You've never eaten at Wendy's? The Dave's burgers? Really? You've never? Oh
No.
man, they're like these square
No.
patties. They have a burger named after you. You should go check it out.
Okay.
I'm actually disappointed. I don't know if you can hear my voice. I'm a little bit disappointed.
Yeah, in a little bit, yeah.
Okay, well, I'm gonna look at DoorDash first. Similar chart to Dell. It has that U shape where it came down during this crash and then ramped itself up. But if you bought the stock 5 years ago, you would be up around 7.5%. And man, we should really be like comparing this to the S&P, because I'm so curious. So I'll throw that in real quick. Over the same time period, the S&P is up 16.5% a year. So if you bought DoorDash 5 years ago, you'd actually be trailing the market, even though the revenue has grown 50% a year over the last 5 years.
Wow.
I don't even know. That's such a big number. I'm curious, like beginning number, ending number. And I have to pull it up. So using the power of fiscal. So that's revenue going from 800 million to 10 billion. So revenue more than 10xing, and the stock underperforming.
Yeah, interesting. That's very interesting, isn't it?
Yeah.
But the market's efficient, right?
Oh yeah, totally. Like, how could it not be? Everybody knows what the price of a growth stock should be.
Right.
Obviously, it's so obvious.
Obviously.
Revenue close to $12 billion. That's a big business.
Yeah, right.
They've become a big business. That's a big boy now.
So what is the price to sales for DoorDash? Like, thinking about what you just talked about with Zoom, I'm just kind of curious.
Right. Yeah, good question. Let's pull it up. So in 2019, price to sales was a 68. It's now come down to a more moderate 9. And the price earnings was negative. So they only got profitable very recently.
Wow.
So they've actually grown into that a little bit better. They didn't draw down 80% like Zoom did.
Right. Yeah. Yeah, for sure. Well, I mean, their revenues are going in the right direction quickly.
True.
Where Zoom's were not.
Very good point. Yes. Do you use DoorDash personally, or do you use any of the apps?
Never.
No. Uber Eats, nothing?
No.
Oh man.
I'm a cheapskate. I prefer to go to the restaurant and pick it up myself.
Yeah. I mean, you can't argue with that. These prices are pretty ridiculous. Gross margin, 50%. Operating margin still low at 5%. So you would think with a software business, can they expand the margins? And you would think that would be the story around the stock. If it can overcome, it's still a pretty high PE, 152. So you would think that, getting the PE lower, you're going to need some of that margin expansion. I don't see the PE staying that high that long when operating margins at 5%. So not to say it won't be done, but yeah, it'll be interesting. I think the business models for these are really interesting. Is
Yeah.
it something that, particularly around the younger generation, have they made it into this habit where they're going to continue using it because they enjoy paying for the convenience, or is it something that that was kind of like fueled by low interest rates? We saw so many growth stocks that were fueling growth just by funneling all this money into subsidizing, basically. In the case of a lot of apps like this, they were kind of subsidizing the growth. So you were getting prices that were way cheaper than they should have been because the companies didn't need to make profits. Now that that's the case, can they continue? From what I'm seeing, I mean, revenue up 28% a year over the last 3 years. Maybe this is one case where they're able to continue it. So maybe it is a secular buying habit, but that's way outside my circle of competence. So I could not tell you whether that's yay or nay.
Yeah, ditto. Right there with you.
Yeah. So I've got a food coma now. We're back at the office. We're back at our computer. I got a food coma thanks to DoorDash. Oh, we didn't look at Wendy's. I apologize.
No, we didn't look at the food. How'd you get food coming without the food?
Okay, Wendy's stock not done well. Down 60% total, 16% a year. That's pretty bad over the last 5 years. Revenue two billion, and revenue growth numbers not terrible. Over the last 3 years, it's 4% a year, but over the last 10 years, it's 1.5. So maybe they're kind of rebounding their revenue growth, but you look at a longer time frame, it's not been a great business story, at least on the top line.
No. It makes me wonder if they are either not organically growing stores or whether they're just struggling with same store sales.
Right.
Maybe they have an older fleet of stores, i.e. they've been open for 15, 20 years. And so the year-to-year sales for those stores are going to be a lot lower, and that would drag down the company, especially if they're not growing very quickly. And so that would cause them to be a lot slower in that realm.
I mean, man, you sound like you've looked at this business, but I'm pretty sure you haven't.
I haven't.
Unit growth has been meandering at best.
Okay.
And then when we look at same store sales, I'll just look at a global. Their best year was 2022, where they had a 10% same store sales, but everything else is under 5. And then you've had 2021 and 2024, which is under 2%. So, yeah, I mean, you got one nice year of 10% same store sales, but when the rest are pretty low, they're not doing great at getting more traffic to those stores.
No. It sounds like you're a fan of the food, so maybe they need a new CEO or some new blood in there to kind of revitalize the company.
No, man, fast food's cooked. I hate fast food. It is so garbage lately.
Okay.
It really is. It's too expensive, and the portions are getting smaller. And that's why everybody's going to Texas Roadhouse, because if I'm going to spend that much, might as well get a juicy steak.
Yeah, true. Very good point.
Okay, now we have a food coma.
So instead of going up the stairs, we're going to take an elevator.
Oh, okay. Interesting. What do you got?
Because we're too tired to take the stairs up. So let's look at Otis and see how the elevator can help us.
Yeah. So ticker symbol OTIS. Stock has been decent over the last 5 years, almost 8% a year for the stock. A $14 billion sales company, and revenue is slow lately, but earnings per share continuing to grow at a nice rate, 9 and 12% a year over the last 5. So earnings per share growing well, even though top line's meandering.
Okay.
What are your thoughts on this?
I have seen and heard people discuss it as a potential stable cash generating cow that could be a great investment, but my gut tells me that you're going to have to expect GDP growth, dividend, buyback, and pray for the best.
Right.
So if you are going to go all in, I don't think this would be the company to do so. But if you wanted to use it as a bond proxy per se,
Right.
that this could be something that would be a nice fit for that.
Yeah, I like that mentality a lot. So we've taken the elevator. I want to finally sit at my computer and then veg for my food coma. So, what is going to be the vegging of choice?
Well, it's got to be Netflix.
Okay. Yeah. To all the bosses who are listening, just put earmuffs on because all of your workers are
Right.
totally not doing this.
Well, we're still doing it on our lunch break,
Oh,
air quote
okay.
lunch
You're
break.
right. Yeah.
Yeah.
Working
So we're not
lunch
on
and
company
then,
time.
yeah,
Yeah.
good thinking. I
We're
like
not on
this.
company time.
Okay. Stock has been ridiculously good, 18% a year over the last 5 years. It's got that trademark U, but a nicer takeoff after the drawdown. Um, man, Netflix, Salesforce, and Google almost have the exact same revenue profiles. Revenue growth is still pretty high, almost double digit, but it's not as big as it used to be. Like it's slowing, but it's still a lot higher than most any stock that you'll find, particularly on the profitable side. Revenue of almost 42 billion. So
That's a big company.
yeah, big company. Is that global? Do you know if it's a US or global revenue kind of business?
It's it's global.
Is it?
Yeah. Yeah. It's global.
Return on invested capital of 15% now, according to fiscal over the last 5 years on average.
Not bad.
That's higher than I thought because I know they're spending so much
Mhm.
on content. So maybe they're starting
Right.
to finally. I remember when people would talk about Netflix, like back during the pandemic and everything,
Mhm.
everybody said, oh, they're going to spend, and just make crazy amounts of original shows and content. And then it's going to have this compounding effect over the long term. You look at the ROIC now for the company, and it looks like, hey, they don't need to spend as much. And maybe there is that compounding effect that everybody had been talking about for so long.
Yeah. For sure. I mean, it's gonna be interesting to see what happens once Stranger Things is done.
Right.
If that, if they need to spend crazy amounts again to find the next Stranger Things.
Yeah. I mean, the stock is priced as if that's not going to be an issue. Price to earnings of 50. So it's gotten quite expensive.
Hmm.
Let me ask you this. When you look at Netflix spending $10 billion to make however many shows versus Disney versus who would be another one? Is it Discovery is another one that's like public?
Yeah. Yeah. Warner Brothers,
Warner Brothers. Yeah, there you go.
Warner Bros. Yeah.
Versus like a Warner Brothers. If you see them spending like 2 billion, 4 billion, 10 billion, and you look at Netflix, do you look at that spend the same? I mean, when we look at like if I'm looking at cloud companies, I look at the capex. I'm thinking that it's a similar capex spend, similar return profile. But when you talk about original programming, TV shows, streaming, what's the answer there? I don't know, and I'm completely curious. And I don't know if there is one, but
Yeah. I guess I don't know. I can speculate that maybe Netflix has had more hits
right.
than some of the other streamers, and so maybe they're more effective on their spend
Mm,
than some of the other ones. Like it doesn't feel like they've had as many busts as some of the other labels have. So maybe that's helping. Maybe I would look at Netflix like, okay, they're being air quote more prudent in their capital allocation by spending on shows that have a higher likelihood of being successful, whereas maybe the other brands like Disney has had a fair amount of duds, and so that would lead me to think, okay, well, maybe the money that they're spending is not as well spent as maybe Netflix is.
yeah. Well, you could argue two things, right? You could say yes, they've wasted the money, or you could say, hey, this is long term compounding. They're going to do what Netflix did 5 years
Right.
ago.
Yeah.
Warner Brothers has really had a really bad ROIC. 0.6% over the last 5 years is their average. They have been growing sales a ton, but yeah, ROIC is bad. And I just have to check Disney because it's been so long since I've looked at them. But ROIC of almost 4%. Well, I think we've done 8 hours at our job. I think that sounds about right, right? Like
Yeah,
We
I
did we
agree.
did a little CRM. We did a little bit of clicking around on the Dell computer, and we've officially had
Mhm.
lunch and did Netflix, and now it's time to go home.
We're both tired. It's been a long day. We've been working hard, and it's time to go home. And we discover that our car's not working, so we're going to take an Uber home.
Okay, this one was interesting to me. Everybody's heard about Uber, everybody's heard about Lyft, but I don't think people realize just how dichotomatic their stories have been. If you bought Uber over the last 5 years, the stock is up 20% a year, which is really nice. If you bought Lyft at the same time, the stock actually went higher than Uber for 2 years, but you would now be down 18%. So you would have lost 4% a year buying Lyft. And if you would have bought Uber, you would have doubled your money.
Hey.
So
Wow. Okay.
quite different story between the two of them.
Yeah. Quite. So, what kind of numbers has Uber seen over the last few years?
Revenue growth, insane. 22% annually over the last 3 years, 31% annually over the last 5 years. And I say that so casually, like those are such easy numbers, but those are huge growth numbers for revenues. And they've hit revenues of 47 billion. So that's the theme today. Just have a software company and grow it to $45 billion in revenue. And you're going to
Yes.
have a lot of stocks to choose from in today's stock market, just with those kind of
Yes.
numbers.
Yeah, for sure.
What do you find interesting about them?
I think it's interesting that they were negative. Their profitability was underwater for a very long time,
Mhm.
and more recently they've been able to become a profitable business. And it's interesting that a business model like that, which was certainly disruptive, took so long to become a profitable business. And when I say profitable, in a way that they can self fund themselves, they don't have to go out and get outside money. And so I think the company is kind of going through the growth tantrum of going from VC money to self funding is probably a bit of a mind shift change for management. And so it's going to be interesting to see going forward how they continue to grow and expand. But they've certainly defied a lot of expectations or logic over the 15 years or so the company has been around. So it's pretty impressive.
Yeah, very, very impressive. Maybe still some room for margin expansion too, if operating margins 9.5. But I don't know how
Yeah.
they expense driver costs, so I could be way off
Yeah.
on the fact
Right.
that they could do margin expansion or not.
I think the last thing I'll say about the business is that it 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 seems like it's done really well, but there still seems to be a lot of uncertainty hanging over it, i.e., the robo taxis and Waymo and some of those kinds of things, and how all that's going to play out over the next 5 or 10 years. I don't think anybody knows.
No, no, I think that's a really good point.
So it's far from a certain slam dunk kind of business for sure.
Yeah, I agree.
All right, folks. Well, with our Uber ride arriving at home, we're going to go ahead and wrap up our conversation for today. I hope you enjoyed our part 2 of finding stocks in your everyday life. This was kind of fun for Andrew and I to kind of walk through some companies that you could encounter in your daily life. And I think it's a great way to try to find investment ideas outside of the usual sources, if you will. Peter Lynch likes to say, buy what you know. And this could be a way that you could discover something that was right in front of your face and you never thought of before. So with that, we'll go ahead and sign us off. You guys go out there and invest with a margin of safety. Emphasis on the safety. Have a great week, and we'll talk to you all next week.